All right, yield nerds, we are fresh off a trading day where there was good news. The job market is strong, the economy is strong. Oh my God, that is bad news. And so the market crashes. How about that? What if there is real bad news? Bad news that we cannot control. That is called a black swan, something unexpected, like a COVID. But there could be four black swans in January 2025. I'm going to analyze all four of them and make my own investment strategy. You do yours. And as I analyze these black swans, I picked a dramatic stock and I will share what that is. And let's go right ahead. 445 subscribers. Thank you for your support. There are two playlists, the Income Investing Roadmap and Preferred Stocks. And the roadmap is this show in a chronological order from episode number one, and Preferred Stocks is just on preferreds. Before you subscribe and before you take anything I say to heart, please remember I have no magical powers. I could be wrong. I learn a lot from your feedback, so do your own due diligence. Well, I organized today in four parts. One, just taking a market temperature of where the market is and where my yield nerd strategy is. And then I'll review what I believe are the four black swans in the first quarter, maybe even in January. And based on that, I will share what my investment thesis is and I will share what my holdings are. All right. Well, look, I am crawling back to where I was before the election. I took a lot of profits right after the election because I made some really good calls before it. And now I am slowly crawling back to putting my bets on where I think things are going to go. And I may be right, I may be wrong, but I'm starting to increase my equity allocation. So, speaking of which, my allocations are in three very specific sectors. I have been adding a lot in information technology. Meta, for example, is one I'm adding because I believe TikTok is going to be banned by the Supreme Court. And we're going to find that out between now and January 20th. And the new administration may give them a new leash on life, but there will be some level of turbulence. And turbulence is good for competitors. So Meta might have an upside. So I'm betting on it. I bought a bunch of Meta. I'm holding on to CalMain. And so, how did I do in the last few weeks? Well, you may remember I was thumping my chest saying, look at that, I am going vertical. I figured this out. Quantum computing is where my action is. And turns out, oops, a nasty crash. Thank you, Jensen Huang, for torpedoing quantum computing stocks. But hey, when my portfolio tanked, so did the NASDAQ. I am still more than double 250% of the performance of the NASDAQ in the last 3 months. But I want to make sure you know that my equity allocation is a really small portion of my total allocation. My total allocation is a steady eddy, mostly in fixed income, and so it really never registers a blip. And that hasn't changed much now either. The benchmark moves left and right, but the blue line just keeps going. And so my total returns went from 6.1% to 5.88% with all the turmoil going on in the market. I'm totally cool with it. So now let's go to the four black swans and see what they are. All right, black swan number one. And before I go there, pardon me, I want to reiterate what I'm about to share is my personal education. I am not a wealth management advisor. This is not investment advice or tax advice. I don't do politics products. I have no t-shirts to sell. So make sure you know that I'm just sharing my thoughts. Black swan number one. And this is happening in some ways today and the last 2 weeks. The long end of the yield curve is becoming steeper and steeper, and that is called bear steepening. If you don't know what bear steepening is, please watch episode 142 where I go through that in detail. And we are at episode 151, so roughly 9 weeks ago or somewhere around that is when I called bear steepening. And if it happens at gusto, if it happens with gusto, we are in trouble. The equity markets will crash. So here's what this means. We saw the yield curves. We've done this yield nerd several times. And the yield curve completely came down, but now you can see the front end is crashing and the back end is coming up. Bear steepening would look more like that, where the back end completely rises up And that creates big, big problems for the economy. What that means is investors have lost confidence on the long-term outlook of the US Treasury. Interest rates are going to go very high on the long end. Stocks will collapse. Capital will flow into possibly not even bonds or stocks. Who knows where it'll go? And these are the kind of twilight zone moments that I wait for. A lot of my allocations are in the short end of the spectrum. If all of a sudden the long end goes very high, I will eagerly snap up some of the long ends. Well, it all depends on how bad it is or how good it is, so we will see. So that is, one black swan that can happen in January, or if not in January, in Q1. What about the next black swan? The next black swan is also kind of sort of happening, some level of geopolitical tensions. What I mean by that, Ukraine war, we don't know where it's going to go in the near term. When the new administration is there, Middle East, who knows where that is going to go again in the near term and with the new administration. And that is the next black swan. So if one of them escalates, the other de-escalates, they all have their own effects on the economy and global trade. And so, we need to think through what that means and how you want to invest based on your judgment of the economic turmoil that would come from the geopolitical conflicts. There is a black swan number 3 that is also emerging. Black swan number 3 is nearshore geopolitical tensions. And, to the south of the border, there is some immigration related tension. To the north of the border, trade dispute related tension. That could boil over. That could create its own effect on the economy. Who knows where that is going to go? So you need to think through what you're going to do, and I will share what I'm thinking about each of them. The fourth one is an exciting one for me because I can watch it happen step by step and do some things based on that, and that is an earnings recession. Let me explain what I mean by that. An earnings recession means more companies fail to beat their earnings estimates than expected. To give you perspective, last earnings season, 76% of the companies met or exceeded their earnings. That's insane. And so, can they do that this earnings season? If not, then we will have a catastrophe. That is the onset of people saying, oh my goodness, I can no longer meet the earnings I said I would be able to just 3 months ago. So let's talk about how you can monitor it, and I'll tell you how I monitor it. On Schwab, and please use whatever brokerage you use. I have no allegiance to Schwab, no sponsorship, any of that. You would go to Research, US Markets, and then there is this little button on the side next to the calendar called Earnings. You would click Earnings. It shows what looks like a fine-looking calendar, and you can then click on each of those dates. Here I am clicking the 10th, and you can see on the 10th, it shows a list of stocks that give their earnings before the market opens and the list after the market closes. And you can see what their year ago earnings for the same period was and what they think they should get this season. And here, for example, this particular company, Constellation Brands, they made 319 last year, same quarter. They're expected to make 331. And just looking through stuff like that, you can if you put them side by side, for example, here is the 319 and the 331. Look at Delta Airlines. Delta Airlines made 128 last year, and they need to pull a lot of weight this time around and make $1.74. Walgreens just needs to do half of what it did last year, and they are, off the hook. And the market generally reacts if you beat earnings estimates in a positive way, as long as you beat both the top line and the bottom line, and there are some outlook related things. But in general, it's good to beat the estimate at the minimum. And so if you see just this simple example, there are a couple where you're expected to make much more than last year, but a large number of them, if you barely scrape the bottom of the barrel and make exactly what you made last year, the market applauds. How about that? TD SYNNEX can make less than what it made last year and say, look at this, we made $3.07. We beat estimates. as though we are supposed to sit here and say, nice job, only bringing in 6 cents per share less than what you did last year. But that is the reality. As long as you keep exceeding your estimates, the market applauds. And that is where I think the rubber meets the road. These estimates obviously are not very aggressive. The estimates are conservative. And if you cannot even meet the conservative estimate, and if 78% of the companies don't meet the conservative estimate, and instead only 50% meet them, or some lower number, then the dominoes will fall. That is what an earnings recession is. So, what is my investment thesis in terms of all four of those black swans? Let me go through the first one. Bear steepening. I am pretty confident that we're going to have more and more increase of long-term interest rates. I'm not jumping into it yet. And so I'm just going to sit tight and, let the new administration set its tax policies, deficit spending, tariffs. These will all, in my humble opinion, increase long-term interest rates. And so when it crosses 5 or something north of 5, I will jump in. Now, on the other hand, you could say the Congress, the majority is so slim that no matter what the idea is, good, bad, or ugly, it's very hard to get it through. So some of these things may never happen. Regardless, instability is not good for the market. Some of the policies that drive up deficits are not good for the market. So I actually do think there will be more bear steepening. I don't know that it'll happen in January 2025. So I'm not extending duration, but I do fully intend to do that if the bear steepens. What about the next black swan? New wars, escalation of conflict. This is unfortunately, the one of the things that could happen, even if our government does not try to escalate it, the other side might try to escalate it. So there is indeed a real possibility that we would have conflict in the near term. And so I bought a bunch of military stocks, and I'll explain what they are and which ones they are in a second. Let me go to the third black swan, which is nearshore conflict. Could it be that all of a sudden we throw a bunch of tariffs and there is an immigration related crackdown, and people in the north and people in the south are upset at us and there is a huge catastrophe? My humble opinion and common sense says we depend too much on our neighbors and our neighbors depend too much on us. So they may talk loudly, but hopefully they'll postpone drastic action at least in Q1 2025. So I am pretty much going to say, I don't really need that. But I did pick up some law enforcement stocks. I picked up some emergency stocks. RevG makes fire trucks with all the natural disasters going on. MLR makes tow trucks. And so I picked up stocks like that. Then let me go on to the third one, which is the earnings recession. And this is where I started to dive very, very deeply. How likely is it that a large percentage of companies will not meet their earnings? Let's talk about that. In order to dive deeper, I'm going to point you to an article called Earnings Insight by FactSet. So FactSet releases statistics on estimated earnings and actual earnings sector by sector. It's a fantastic paper. The link to that is on the description of this video, so please go find it there. And so here, for example, is a very nice kind of overview that says, the S&P is expected to report 11% more in earnings. That's a shocker to me, that, somehow all companies will, on aggregate, report 11% more. And as you digest the fact that that is 11%, your eyes have to go over here and you have to do a double take. Financial companies are expected to report close to 40% more in earnings this year in this quarter, Q4, compared to the same time last year. And you go, what? How is that possible? Well, that is what they signed up for. What about energy companies? Energy companies are expected to report 25% less. So just step back and think about what that means. If you, for whatever reason, believe there is an energy company that will only see a 20% reduction in earnings, they will look like a superstar. If you see a financial company that only reports 30% increase in earnings, they will look terrible. But that is what the industry has signed up for. the forecasts are for these hugely divergent earnings to come up. Then you sit there and go, all right, is it common for financial companies to come above guidance? And this again is from the same FactSet article. And this is where I told you 75 something percent of the companies in the last quarter, Q3 2024, 75% of them went above their forecasts, which is astounding. And 82% of financial companies went above their forecasts. And that is when you go, wow, financial companies are having a time of their life. Maybe they indeed will not have any trouble smashing their earnings forecasts. I'm really interested in financial sector. Maybe I should go buy a whole bunch of bank stock. Let me educate myself more. Then I start looking at, okay, if that's the revenue and they are smoking it, what about, if that is earnings, what about revenue? Well, turns out 55% of the companies beat their estimates both on the top line and the bottom line. That's just amazing. And hey, look at this, 70% of companies in the financial sector beat both the top line and the bottom line. You have to look at that and go, wow. And you look on the IT sector, you can see that number is even higher. IT just demolishes estimates. And so that's why IT stocks are going up. And you go, okay, I'm learning something here. Financials still look very good. So I started diving deeper and I built a little screener that said, show me American companies that have a lot of stock, whose earnings are coming up in the next 30 days. They have a good dividend. And their price to cash flow is 11, meaning I'm not paying a whole lot. Their profit is at least 24%, so there is a big margin, low debt, and I don't want to pay too much. My PE ratio has to be low, and I don't want this to be 1% owned by institutional investors. I want a lot of big bad people breathing down their neck to make sure that they're going to, do their good job. And oh, by the way, I just want to look at banks and consumer finance within the financial sector. And I found 10 companies whose earnings are coming up. Here are the 10, and look at their profit margins. It is astounding. Bank of the Ozark, 44% profit margin, and so on. Not only that, Bank of the Ozarks has a price to cash flow ratio of 6, a debt to equity ratio of 8%, a price to earnings ratio. Bank of the Ozark looks like a superstar. I did a quick check. That is Bank of the Ozark earnings per share. It only knows one way to go, up, up, up. Revenue only knows one way to go, up, up, up. Cash flow only knows one way to go. And in the meanwhile, their next quarter earnings forecast is piddly. So I am hoping that they destroy their earnings. Banks and financial sector is the place to be. I am very, very hold on one second. Let me just check one fine print in that paper. That paper clarifies, hey, by the way, there was a change to the special assessment by the FDIC. And the special assessment used to be excluded from earnings, and we're now going to allow them to show it as earnings, even though it really is not earnings. And so that 39% will really be 11% if you left the assessment the way it is. And I'm like, oh, okay, I see what's going on. So if we excluded all the base hits and only took home runs and counted them as 10, the Chicago Cubs would have won the World Series every year, something like that. So moral of the story, there isn't really a clean 44% profit going on here. The rules have been changed. Nevertheless, I do believe financials will beat estimates based on history and based on where they are. So I started trying to understand, okay, what about target price versus actual price? Where do we stand there? And it turns out that materials, the target price is much, much higher than where it stands. Healthcare comes in second. I really like that. So on average, people are forecasting a 15% increase in the S&P, however, a 23% increase in healthcare stocks, and that is what catches my eye. So my mind goes to interesting. I want to really focus on materials, healthcare, and energy, and all those look like they have upside. Now, this is based on industry experts. What do I know? Then I say, hey, what if these black swans come into the picture? What if there is international skirmishes? What if there is nearshore problems? I need to pick companies that don't have a lot of international exposure. Which sectors give me that? Turns out healthcare has plenty of that, and financials are also pretty good. So if I were to kind of take it all together, looking at the earnings recession that potentially could happen, geopolitical conflict, and if I want to avoid a lot of international exposure, that then informs where I want to go. So here is my thesis. My thesis is that one or more of the black swans will strike in Q1 2025, but January may not be the time it does. And so I started adding good healthcare companies and some financial companies. I don't know whether I'll hold the financial companies for a long time, but let me tell you what I did buy. I did buy Bank of the Ozark. I literally bought it this morning, but most of these are not new names. Bank of the Ozark is my new stock. I am hoping for good things from them. But other than that, I'm still sitting on the house money from the stocks. Target and Moderna, which I bought at 5-year lows, have been going up since then, and I'm getting lucky there. I do believe TikTok is going to have a comeuppance, and when TikTok has a comeuppance, Meta and Snap should see increase in share prices, so I picked them up. Outside of that, I do have some of the same stocks from before. There is nothing new here. I did pick up Fannie Mae and Freddie Mac, but we'll see where we go. I told you I picked up some military stocks, so I picked up Kratos, I picked up Curtis Wright, which initially was down, but I'm expecting for some good results from them. You do you, whether you choose to buy Bank of the Ozark or military stocks, make sure you make your own decision. Thank you for watching Yield Nerd, and have a good day.